Introduction and information for the terms of use of the Forex Day Trade Planner. Welcome to Forex Day Trade Planner and thank you for your interest in our service. Our aim is to help you trade Euro US dollar and Pound US dollar with success. This unique service is made for traders in the Forex market with some experience in technical analysis and money management, who understand of the risks involved in Forex trading. Here is how our service works. In the evening before every trading day you will receive one or two charts of the markets that you are subscribed to, either Euro dollar of Pound dollar or both. In these charts we set up the next trading day by looking at the different market conditions. What do we mean by market conditions? First we have fundamental conditions driven by economic and other news. Secondly, we see technical conditions, where major players move large positions. And third we see sentiment as main driver for the markets. Of course all three conditions can work at the same time. Forex Day Trade Planner simply puts all these conditions into an overview for the phases the Forex market goes through every trading day. On top of being just an ordinary calendar, this planner features a unique way of plotting expected market sentiment, the third condition, a long time before it actually appears. This I will explain in a moment. First let's take a look at the planner. It is a 24-hour daily chart, shown in Central European Time, in the summer being GMT+2 and in winter GMT+1. The first condition, fundamental news, is shown in a table beneath the chart. The moment the news will be out is shown in the chart by flags with corresponding colors, green for European news, red for news from the UK, and blue for news from the United States. News events can be extremely market-moving and damaging. They produce spikes in prices, and can gap over stop orders, leaving you with a loss greater than you can afford. For this reason we place the flags, clearly visible in the chart. The second market condition we want to stay away from, or at least be very careful with, is technical. In these zones the market is not flowing naturally, and is being influenced or manipulated by major players opening and closing large positions. For them to do this profitably they suddenly push the market in one direction and quickly reverse after their orders are filled. They need to reach price areas of high liquidity with many stop orders, which they can do when the cash markets are still closed in the morning or at end of day closing. These areas are marked blue in the chart. If you are not familiar with this, then it is best to stay out of the market. There are also blocks of gray, times when our markets, Euro dollar and Pound dollar, are thin. We advise to trade very careful during these hours, especially if you use the probability indicator. The probability indicator works only in markets with a lot of volume, because it measures the third condition, market sentiment. In recent years, I started to notice that the market tends to repeat itself in certain periods. I decided to look into this deeply. By modeling and testing on a lot of historic data, I found algorithms that correlate closely to this repeating market current, forming trends and intraday swings. Of course, in these trends, the prices do not repeat themselves, but the upswings and downturns are often at the expected time. I then proceeded to make a chart in which this probability is shown as graphs. The candle chart shows possible movements every 15 minutes and the dotted line shows possible slowing down and speeding up of the trend. They should be judged together to form the best impression of the trend. Drawing lines is a bit dangerous, because you could think of the graph as a price chart, which it is not. Bear in mind that you are looking at a probable direction, and not at a price level. This is very important for you to understand. Do not trade the chart, but plan your own strategy according to the direction it is showing, not the level it has reached at some point. You may also have noticed red and green triangles in the chart. These are a second part of our probability analysis. They are not part of a flow, but are incidents in time, formed by a confluence of currents, that can have a profound local impact on the trend. We have to mix them in our trend expectation accordingly. This all becomes clear when we put the real outcome over the probability chart. Added on is the 15-minute candlestick chart for Euro-Dollar for this Friday. As you can see, the basic uptrend has appeared in reality and the pullback at the end of the day is also there. The US dollar negative incidents at noon have helped lift the euro into the 1.12 price handle, which it tested twice before falling back. This is a good example of where our probability indicator meets reality. The uptrend is clearly there, but is not strong enough to break through an important resistance level, after having rallied 100 points in 2 hours. So mixing the probability indicator with the technical condition of the market is something we do ourselves during trading. Now, here is the euro-dollar chart of the previous day. The trend after 9 AM is weak, and there are several incidents between 9 and 11 which are weighing on euro. In the afternoon we see some divergence between the probability line and the impact line, which means there should be some confusion in the trend. But incidents keep pulling on the downside, so we will be trading short all day, using the upswings as pullbacks to sell. In this way we build our strategy before market opens. Now let's put in the real price. As you can see, the market fell hard in the morning, the trend probability and the incidents working together for a real sell-off of 100 pips. The rebound that we expected around 1 PM also showed up, so we could short again for a range-bound retracement. So this is how we plan our day. First we study the news moments and prepare ourselves for the impact they might have on price development. Secondly, we plan to be in or out of certain technical periods. You could decide to do so likewise. Thirdly, we take a look at the probability indicator and prepare for certain swings that we would like to use. Finally, when we look at last Monday's chart of GBP against the dollar, we see that the same logic applies here as well. We once again stress the fact that our probability chart is a trend chart, not a price level prediction. It is impossible to predict prices. The best we can do is forecast an approximate trend, a best guess, with which we plan our price strategy. If you have any questions or remarks, or would like to receive our daily report, every trading day before 1 AM Central European Time, then contact us via our website, www.ForexDaytradePlanner.com. Subscriptions run from less than €1 per day. Thank you again for your attention and goodbye.